Okay, folks, welcome back. So as I said, after the break, everything's going to hit the fan, and I just want to get you ready. First is I hope you've had a chance to at least download the case. I'm going to be realistic and assume you haven't read it yet. But the sooner you read it, the better, because as we'll go through the next two sessions, you'll notice indirect answers to some of the questions in the case. So if you've read the case, it's going to help you a great deal in terms of saying, okay, now that's basically what we need to do in the case. The case is a group case, and it is due before class starts next Wednesday. So let me repeat that again. It's due before class starts, before 10:30 a.m. next Wednesday, because during class next Wednesday, we're going to look at the case. We're going to take a look at what we can learn from a more general standpoint of capital budgeting. Any questions before we start? So it's a group, so just turn in one project per group, and I'll give you the format for doing it. It's not going to be on Brightspace. It's going to directly come to me so that it's in one space. So I'll give you the directions on doing that before the end of the week. So today we're going to continue our discussion of how to assess a project. And if you remember, we talked about earnings versus cash flows, right? The Winston Groom versus Steven Spielberg example. And I made the argument that the reason we look at cash flows is cash is a much more honest measure of what you actually make on a project. It's cash in, cash out. Let me add to that theme. Not only does it matter how much you make in cash flows, it matters when you make it. You'd rather make it earlier rather than later because earlier cash flows are worth more, especially as inflation goes up. And finally, when you're measuring returns on a project, there's no garnishing allowed. You can't bring in things after the fact and say, hey, the numbers didn't fly, but we're going to do this anyway. No matter how good sounding the reason might be, it's strategic, it's synergy, it's ESG. If you want to bring it in, I'm going to try to bring it into the numbers. So if you ask me to come up with a good measure of return, it'll be a time-weighted incremental cash flow measure of return. Now you're saying, what does an incremental mean? I'm going to give you a couple of examples as we go through projects so you can see what it means, but it's got to be something that comes out of the project. In fact, when I think about the best way of describing how we think about returns in finance, I think about that line from the Jerry Maguire movie. You guys see that? Tom Cruise acts as an agent. Cuba Gooding is a football player. And it's this famous scene. If you've never seen it, you can go on Google and just watch the scene. But Tom Cruise calls Cuba Gooding Jr. and tells him about his contract. Does anybody remember the line that Cuba Gooding comes back with after Tom Cruise goes through this elaborate description? What's the line he comes back with? Show me the money. Show me the money. That's really the bottom line in finance. You can talk about he didn't say show me the accounting earnings, right? He didn't show me the operating profit. He said show me the money. And that's really what we're aiming towards when we look at measuring returns on projects. So when I talk about a project, you might have visions of what a project is. In my view, everything is a project, small to large, acquisitions to internal investments. So when we talk about projects, we talk about big project. When you do if you look at Microsoft's acquisition of Activision, huge project, a $75 billion project. But even installing a water cooler in your office is a project. So small to large, cost savings to revenue generating, they're all projects. In fact, what I'm going to do is I'm going to use 4 examples of projects to illustrate how we think about capital budgeting. I'm going to start and spend the most time on a new theme park that Disney might want to build and talk about how would we assess whether to open that theme park. Big project, infrastructure investment. And I'm going to put this theme park in Rio. Why? Because I used to actually, in the first edition of my book, I had it in Bangkok. And then Disney opened a Shanghai theme park, kind of undercut my geographic reasons for having so I have to keep moving geographies. Hopefully Disney won't open a Rio theme park, in which case I got to move it somewhere else. But this is the project I'm going to describe is a hypothetical project, but it's like one of those movies that's a docudrama. Have you ever seen these? It's loosely based on a story. So basically, it's a hypothetical project that I'm going to base on real projects that Disney's taking. So I'm going to start with that. Very conventional project. Next, I'm going to talk about a new iron ore mine for Vale in Canada. So kind of mixing both a very different kind of investments and it's a mining investment. Talk about it, it's very long term in a country other than the country that you're incorporated in. Then I want to talk about an online store for Bookscape. Essentially, it's finding that fewer and fewer people want to come into the store, want to compete with the Amazons and the other online sellers. I'm going to talk about the investments it needs to make and whether it should go ahead and do it. And finally, I'm going to talk about an acquisition. Again, a hypothetical acquisition. This acquisition, Tata Motors is acquiring Harman Audio. For those of you familiar with Harman, it makes high-end stereo equipment. Why would they do that? Because they want to put in high-end sound systems that cause a synergy. So it'll allow me to talk about synergy control. But my point is these are all projects and we should judge them in exactly the same way. The reason I say that is my biggest concern with acquisitions is they're given their own pathway to hell. In other words, no, it's amazing. A company can take a $50 million internal project and make it jump through a dozen hoops before taking it. But a $5 billion acquisition, no questions asked. It sails through because it's not viewed as a project. So let's start with a Disney theme park. Before I go deeper into a Disney theme park, I want to start with a question. Who in this room has never been to a Disney theme park? We need to raise some money. You seen these Super Bowl ads? Now, after you win the Super Bowl, say, whoever the winning quarterback is, you won the Super Bowl. Where are you going to go next? Disneyland, right? So if you've never been to a Disney theme park, you've still seen pictures of a Disney theme park. Every Disney theme park is centered around the Magic Kingdom. And every Magic Kingdom has a castle. Now, I could check your trivia knowledge and ask you whose castle it is. But let's start with the two most famous ones. In Disneyland, whose castle is in the foreground? Nobody remembers? It's Sleeping Beauty. Snow White never had a castle. No? Poor woman stuck with 7 dwarfs in a cottage. No? So Sleeping Beauty. Cinderella's castle is in Disney World. Belle's castle is Euro Disney. Tokyo Disney is also Sleeping Beauty, but there's usually a castle in the foreground. It's a fake castle, but that kind of goes without saying with everything in a Disney theme park, right? Basically, it looks like a castle, but don't expect to see rooms, and it's not the Windsor Castle. You walk through the castle and you're in the happiest place on earth, surrounded by people dragging, screaming, and crying kids, but it's still the happiest place. It's not my description, it's Disney's description. That internal section you go into has a Dumbo ride right in the middle, and it's surrounded by all the little kids' rides. So the first part of the Rio theme park is going to be a Magic Kingdom. The second part is going to be a variant on Epcot. For those of you who've never been to Epcot, it's one of the, I think, brain-shattering experiences you can go into, right? Basically, it's the entire world around the lake, an artificial lake again. And you can go around the world and eat your way around the world, actually, and essentially get back in 3 hours. They're both going to be built in Rio, which is going to be quite an exercise in logistics. So I'm going to give you the numbers for the theme park, and your job is singular. All you have to do is to make the decision on whether to open the theme park. So I'm going to be a number cruncher. I'm going to give you the information, and at each stage, I'm going to ask you, should we open the theme park? And I'm going to cheat. Cheat in what way? I'm going to give you the earnings and the cash flows for this theme park in US dollars. You see why it's cheating? Because the actual cash flows will be in reais. But at the end of the analysis, I'm going to come back and ask, if we'd done the entire analysis in reais, would the answer have been different? So let's start the process. Let me give you the information on what it's going to cost you to build these parks. So there are two parks. And what's going to cost you to build these parks? I'm going to start with some information. Disney has already spent $500 million researching the theme parks, getting licenses, setting the stage for the theme park. And if it doesn't open these theme parks, it's not going to get that money back. So file that away. It's already spent $500 million. The Magic Kingdom is going to cost $3 billion, $2 billion upfront and $1 billion a year from now. The Epcot is going to cost $1.5 billion, with $1 billion to be spent at the end of the second year and $500 million at the end of the third year. So this is not all going to happen overnight. It's going to take 3 years for the two theme parks to be built, $4.5 billion collectively. So those are the investments you will need to get the theme park started. Now, to make an assessment of whether I'm going to open the theme park, what do I have to estimate? I have to estimate how many people will come into the theme park, what price to charge. So imagine being the analyst who's just been hired by Disney Finance, and you're told to estimate the projected revenues on this theme park. Remember, you're sitting there with an empty spreadsheet, right? What are you going to use as information to populate that spreadsheet? You're going to look at the existing parks, right? That's a logical place to go. You might ask, what if this is the first time we built a theme park? We'll come back and address what to do then. But if you're opening a new theme park, the logical place to start is look at the existing theme parks. Disneyland, of course, has been open since 1958. So that's 64 years. You got Disney World, which has been around for 50 plus years, and Euro Disney, Tokyo Disney, etc. Now, you know that this is a theme park in Brazil. So it's going to have some different economics, but the place to start is with existing theme parks. So let's assume that that's what I did. I went and looked at the existing theme parks to see how revenues built up at these theme parks. Saying, what do you mean built up? Because in these theme parks, the revenues don't kick in year one. It takes a while for the revenues to kick in. And you can see that as you go through time. Now, incidentally, because the second theme park doesn't even open till year 5, it takes a while for revenues to pick up. Those are the revenues at the theme parks. But for Disney, what they make as revenues in the theme park is just a piece of the puzzle. There's an entire ecosystem that Disney has built around the theme parks that also benefits when people come to the theme parks. You know what I'm talking about, right? If you've gone to Disney World and stayed at the Contemporary or one of the Disney resorts, you don't do it because you like the hotel. You do it because it's convenient for you to go to the theme park. In other words, they live off people coming to the theme park. One of the things I'm going to suggest, if you ever want to start building spreadsheets, is rather than make each line item independent, start linking them up. And what I mean by that is the revenues I'm going to make at the resort properties are going to be a function of how many people come to the theme park. And based on what Disney is doing in Orlando and Anaheim, I'm going to estimate that for every dollar they make in the theme parks, they make about 25 cents in the properties, again, based on existing properties. So I have projected revenues from the theme parks, projected revenues from the resort properties. You add them up, you get the total revenues on this theme park starting in year 1, building through. In year 1, they make nothing. Why? Because the theme park is still being built. And as you go through time, that number builds up to become almost $4.7 billion. Remember, your job is to just make a judgment on whether to open the theme park. If all I did was stop here and give you these numbers, do you have sufficient information to decide on whether to open the theme park? Not yet, right? It's revenues. So I'm going to try to come up with the expenses. And here I'm going to make assumptions based, again, on the existing theme parks. Notice how much I'm depending on that to make my judgments. At the existing theme parks, for every dollar that Disney makes at the theme parks, its costs run at about 60%. These are the direct costs of operating the theme parks. In those direct costs, you'll have all the people who work at the theme park, the cleaning up, the maintenance, the regular maintenance. So for every dollar they make in the theme park, 60 cents goes into expenses. At the resort properties, it's closer to 75%. That's a cost, the operating cost of running these hotels. So that's going to give me the direct cost of running the theme parks and the direct costs on the properties. And then I'm going to do something that you're going to see at pretty much every large company. I'm going to allocate general and administrative costs. You see this in every company, right? G&A costs. What the heck goes into G&A costs? Anybody want to hazard a guess? Every company, it's billions of dollars G&A costs. What goes into G&A costs? Have you ever worked at a company where, most of you worked at companies, especially at big companies, you have entire floors filled with people and you have no idea what they do? Like usually the top floors. So what do? They come in expensive cars, they take special elevators up to that floor, they do something up there, they get paid a huge amount, but I don't know what they do. That strategy group, what do? They meet and they meet and they meet, and they send out directives. They don't actually generate revenues. In other words, in every major company, there are costs that don't create revenues. Now, I'm being cynical when I view them as completely useless, but the entire accounting department doesn't create revenues, right? There's a cost center. And accountants hate cost centers. So you know what they do? They gather all these costs together, they put them in a pile, they call it G&A costs, and then they go looking for revenues to attach it to. Oh, you got revenues? How about some costs? You say, no, I don't want them. No, you're part of the family now. So here's what I'm going to do. I'm going to take my G&A and allocate it based on your revenues. Why? Because accountants have to base allocations on something, and revenues seem as good a measure as anything else. So for every dollar in revenues, I'm going to allocate G&A costs, which will be 15% of those revenues. And he's saying, that's not fair. These people are not attached to my project. So I'll be open about it. 2/3 of these costs have nothing to do with your project. They're just existing costs that I'm allocating to your project. But it is true that your costs will create additional needs for accountants and inventory keepers and others. So 1/3 of the costs are coming from a project. 2/3 are just essentially allocated to you, but they will be there anyway. File that away again, because as an accountant, that's what I'm trying to do, allocate expenses. So I've given you the direct costs, I've given you the allocated costs. And then I'm going to complete this process. Remember I said accountants classify expenses into operating expenses and capital expenses. That $4.5 billion you spent up front to build the theme park. In fact, if you include the $500 million you've already spent, it's $5 billion. It's a capital expense. Now, it's not automatically a capital expense, but in this case, you have to pay, if you check the boxes and it turns out to be a capital expense, you don't expense it when you spend it, you depreciate it over time. Now, the old days, companies used to be able to pick their depreciation method. And we'll talk about what drove that choice. But increasingly in the US, the IRS sets a depreciation schedule. You tell what asset you invest in, they give you a depreciation schedule. What does the depreciation schedule tell you? It tells you what percentage of the expense you can depreciate each year. So if you spend $100 million right now, I'm going to let you depreciate 12.5 million in year one. So each year, the depreciation reflects what the IRS is allowing you to claim. So that's my depreciation as a percent of book value. So each year, I'm depreciating what you invested. You say, what's that second column? If you run a theme park and all you did was invest up front and you stopped investing, you know what your theme park would look like in about 3 or 4 or 5 years? Half the rides would be broken, it'd be decrepit. And this is something I think we routinely underestimate when we have big infrastructure investments. It's not just upfront and done, especially if we want this investment to last a long time. So that's what everybody wants, right? I want my investment to last 30 years, 50 years, 75 years. You got to put money not just in regular maintenance, but in capital maintenance. So what is capital maintenance? 2.5 weeks ago, I took my grandson to Disneyland. He's been to his dad works at Disney, so he goes to Disney every other week. It's like his second home. And of course, if you've been to Disneyland, you take all the conventional Pirates of the Caribbean, one of his favorite rides, was shut down. not just for maintenance, but they want to do significant maintenance. So this capital maintenance, it might be shut down for 2.5 months, 3 months. So this is beyond regular maintenance. This is actually replacing a ride or coming up with a new ride. And because in this case, I'm assuming the project is long-term, you notice that, that I'm not only investing, but I'm tying it to depreciation. You're saying why? If accountants are to be believed, what's depreciation doing? It's reflecting what the loss in values of your existing assets, right? So it's a cash inflow for you, it's a benefit. But if I want to keep this project going, I'm going to put some of that money back. And how much of that money back I put depends on how old. So notice early on, I'm putting in relatively little because the park is still new. But as the park ages, you're going to start to see the need for capital maintenance kick in. And why? Because I want this park to keep going after year 10. If I wanted to stop in year 10, I wouldn't be pumping money in year 6, 7, 8. It doesn't make sense. So in this case, you see capital maintenance kick in. So depreciation reflects the accountant's estimate of how much value is lost. Capital maintenance reflects what you're putting back into the project to keep it going for the long term. I'm almost done with the basic information. Disney also needs some working capital to keep this project going. Like what, at the resorts, it needs to keep inventory of different kinds of stuff to keep the hotels. That working capital need, we're going to assume is going to be 5% of revenues. Notice again how I tie everything either to revenues or overall costs. Because ultimately, when I estimate these numbers, I can't estimate them as line items that are independent of each other because they're not independent of each other. I'm also going to assume that these investments have to be made at the end of each year. You're going to see why that's significant when you look at how I estimate cash flows, because you can invest in inventory at the start of each year, the end of each year. Saying what's the big deal? 365 days. 365 days in terms of time value is going to affect your overall values. And finally, I'm going to give you a marginal tax rate. Why don't I just give you an effective tax rate? Remember we talked about effective tax rates being the average tax rate you pay? I'm giving you the marginal tax rate because this is an additional project to Disney. The income it brings in will be extra income. So you have everything you need. I'll be your number cruncher. But as I crunch these numbers, I want you to think about how I'm crunching these numbers, because on your case, you will be crunching the numbers. I won't crunch them for you. So let me start thinking from the accounting perspective. Let's start with an accounting view of this project, and then we'll very quickly abandon it. But the reason I'm going to start with an accounting view of the project is half of all project analyses in the world is still based on accounting returns. So even though I don't like it, at least I need to understand it. So let's start with an accounting view of the project. What does that mean? When accountants think about investment in a project, they think about what will show up in the balance sheet. What's the book value of this project, right? And think about how book value is determined. It's determined by the CapEx you put into this project. That's what starts the book value going. Every time you depreciate, that reduces your book value. Every time you have capital maintenance, it goes back into book value. So basically what you see here is the book value of my fixed assets based on my starting investment and my schedule of depreciation and capital maintenance. Incidentally, if I hadn't put any money into capital maintenance, what's going to happen to book value over time? It'll always go down. So whenever you have a project where you don't put in capital maintenance, it's a feature. Basically, your book value will decrease. It's not decreasing here because I'm putting money back into the project. Working capital is also part of book value. Why? Because you look at a balance sheet, current assets and current liabilities show up there. So each year I've computed the book value of working capital based on 5% of revenues. Yes? It's net working capital, but give me a definition of net. So make sure we're talking about the same thing.
So it's current assets minus current liabilities, extracting excess debt.
Just all cash.
Okay.
We won't even draw a line between excess and operating cash because from my perspective, it doesn't really make a difference. And it also takes our debt from current liabilities. So it's non-cash current assets minus non-debt current liabilities, because from a finance perspective, debt is source of capital. So it'll be accounts payable, supplier credit, deferred taxes. So that's the 5% of revenues. So that's the total working capital each year. Everybody with me so far? So when you look at the book value of a project, or I'm just following traditional accounting, book value is reflecting the capital expenditures I make, the depreciations I have, and in this case, the capital maintenance over time, and I'm adding the working capital. So if you ask the accountant, how much money do you have invested in this project over time? He's going to say it starts at 2.5 billion, and by the end of the project, it's about 4.2 billion. So from the accounting perspective, if I ask you, is this a good project? What are you looking for? Looking for how much earnings do I make on this investment? So here I'm going to estimate the earnings, and I'll take you line item by line item. It's very simple accounting, but I want to make sure that you're with me on the computations. I start with revenues based on the assumptions I made about revenues building up over time. So revenues go from 1.25 to 4.7 billion. I subtract out the direct expenses. The direct expenses are 60% of revenues for the theme parks and 75% for the resort properties. So I end up with total direct expenses. I subtract the direct expenses. Then I subtract our depreciation and amortization. Why? It's an accounting expense. I'm allowed to deduct it for taxes, so I'm going to deduct it. Do that for taxes. You always have to do that, even though we'll talk about how you might add it back at the end. Never ignore depreciation and amortization. I've seen bankers do this. Let's do EBITDA because we're going to add it back anyway. It's not that simple because depreciation will affect your taxes. I also subtract out allocated G&A. Why? Because I'm thinking like an accountant. The accountant says, I'm allocating the expense. I'm going to allocate the expense and subtract it out. I come up with the operating income. I act like I pay taxes on the operating income. Why did I say act like I pay taxes? What am I allowed to deduct from operating income before I pay taxes? Interest expense. I'm ignoring interest expense. And a little while, you're going to see why I'm doing it. But I'm focusing on after-tax operating income. And guess what? On this project, I'm going to lose money in year 1 and year 2. And when I lose money, I should be paying no taxes, right? But I seem to be paying negative taxes. What exactly am I assuming that Disney will be doing in year 1 and year 2? When I lose money, what's that negative tax capturing? Yes. If I rolled it, I should leave it at 0, right? Because then I should show it in future years. I'm not rolling it forward. So the question I'm asking is, why am I not rolling it forward?
Marginal tax rate here, so they're probably going to compensate that with the earnings that they have in the year.
Disney doesn't pay taxes on individual projects. It pays taxes as a company, right? It's got profits in Disneyland. It loses money on this. It's going to offset it. Why? It has a choice. If it wanted to, it can roll it over into future years. But ask yourself the question, would you rather take the tax savings right away, or would you rather wait 2 years? The answer is, I'll take it right away. When you have a profitable company taking a money-losing project, when you lose money on the project, you're going to get the tax benefit right away. But if you're a money-losing company taking a money-losing project, this is not going to work, right? Then you got to carry it forward because you don't have the benefits of taxable income on the rest of your projects. So implicitly, I'm assuming here that Disney is making money, but I can go check its income statement. It doesn't have to be implicit. And if they have enough taxable income, clearly they're going to take the tax benefit right away. So here's what happens. They lose 50 million before taxes in year 1, but because they get a tax savings of 18 million, that's 36% of 50 million, their effective after-tax loss is smaller. So they lose money in year 1, lose money in year 2, lose money in year 3. And if you ask the accountant about break even, he's going to say, we're going to break even in year 4. That's when our profits start. And the profits then build up over time. It's after-tax operating income. And on the previous page, you looked at the book value of invested capital, what you've invested in the project. If I showed you this page and then, are you ready to take the project? Now it's still incomplete, right? It looks like I can make a lot of money, $421 million. It looks like you have a lot invested, 4,243 million. But you see what the final link here is? By themselves, they're absolute numbers. I'm going to convert them into a percentage return. Again, no rocket science here. I'm just taking the accountant's measure of what's invested in this project, book value of capital, and I'm dividing the after-tax operating income by the book value of capital. It's called return on capital or return on invested capital. And basically, the story it tells of a project that doesn't look good in year 1, year 2, year 3, and then over time, the returns on capital start to improve. In every large infrastructure project, this is the pattern you will see. Early on the project, it's a toll road company, it's a power plant. Early in the project's life, you will tend to lose money. And over time, those returns will improve. Yes?
The second column, book value of project investment, shouldn't that be a sunk cost?
From an accounting perspective, there's no such thing, right? When I look at a balance sheet, if I've spent 50 million was capitalized, that 50 million is part of my investment. Now you're thinking like a finance person. You're saying this is about cash flows and I don't have to spend the 50 million. But for the moment, as I said, I'm going to keep the accounting perspective. So when people talk about return on invested capital, they don't talk about return on future invested capital or what it does mix together things you've already spent and things you haven't spent yet. So it violates one of the principles that we look for, right? Incremental. It's clearly not incremental. So we'll come back and clean up for that. But for the moment, I'm still staying with the accounting perspective. So my returns on capital. And you're saying, why are there two returns on capital? Returns on capital can be computed based on starting numbers, average numbers. I've used both. They tell pretty much the same story. The average return on capital based on average is 4.18%. And if I use the start of the year numbers, it's 4.11%. Question? Yeah. Yeah. Yeah.
But when we factor in the sunk cost, that calculation actually makes things a little.
Well, you're thinking like an accountant. It's an accounting decision. To begin with, these are earnings, not cash flows, right? Already you violated the first part of the three parts. It's earnings, not cash flows. It's total earnings, not incremental earnings. You screwed up 2/3 of the process. Might as well screw the whole thing up. It's not time weighted either. I'm taking a simple average. So from the perspective of, is this a good measure of return? It fails on all three levels. But guess what? Half of all projects around the world are judged based on return on equity and return on capital. And what I'm trying to bring home is they're measures that people use every day, but they come with all three of these flaws built in. Now, I have a return on this project. Roughly speaking, it seems to make a 4% return. Now we're getting closer, right? You ready for the decision? I'm going to give you a choice of things to compare to, because you're saying is 4.1% or 4.18% good enough? You got to compare it to something. I'll give you a choice with each one. Tell me whether this is the choice you'll make, and if so, why? Or if this is not the choice you'll make, and tell me why not. I could compare it to the risk-free rate, 2.75% on that day. Why not? What's
You're not including all of the risk that is associated.
In other words, it's not guaranteed, right? If somebody told me I can guarantee these cash flows, and that somebody can't be the Brazilian government because there will be default risk. But if the US government said, hey, we'll guarantee, then I could use the 2.75%, but I cannot use the risk-free rate because these cash flows are uncertain. So let's cross that out. How about the cost of equity? And I give you two choices for Disney as a company or Disney theme parks. Focus on the cost of equity. Why not the cost of equity?
You're looking at earnings without taking into account interest costs.
And I'm looking at total investment in the project, not just the equity investment in the project. Remember I said, what you use as a hurdle rate will reflect how you think about returns. When I computed returns and invested capital, I took the total amount invested in the project and the income I would have before interest expenses. That's why I didn't subtract our interest expense, that return on capital. And when I use return on capital, I can never compare to the cost of equity, because that's comparing apples to oranges. So you can cross out B and C, not because they can never be used, but because of the way I've computed accounting returns, it can't be compared to a cost of equity. We're getting closer. So it's not the risk-free rate, it's not the cost of equity. It has to be cost of capital, right? And I'll give you two choices. I can compare to the cost of capital for Disney as a company or the cost of capital for Disney theme parks. We kind of answered that question. What do we conclude that you should be comparing it to? Cost of capital of theme parks. But before you nail that number down, I have one qualifier. See this 6.61% that I computed with the theme parks? What are Disney's existing theme parks? Let's go down the list. There's Orlando, there's Anaheim, there's Paris, there's Tokyo. In 2013, Shanghai hadn't opened. In other words, every single one of Disney's theme parks were in developed markets. You see where I'm going next? This theme park is going to be in Rio. So let's start with an obvious question. Is a theme park in Rio more risky than the theme parks Disney has right now? On multiple levels, right? First, there's exchange rate risk. But if exchange rate risk were a concern, I should be charging a higher discount rate when Disney opens a theme park in Frankfurt, Germany, even though it's a safe country, because there's always going to be a different currency. And I'll be quite honest, a company like Disney, exchange rate risk is not even on my radar. And here's why. Remember I showed you the top 17 investors in Disney? People like BlackRock and State Street and Fidelity. I mean, remember, they own companies around the world. The dollar gets stronger or weaker. Some of their companies are helped, some are hurt. Because of the kind of investors that Disney has, the last thing I want Disney doing is going out and rejecting projects because they think exchange rates might move against them. So if exchange rate risk were the only concern, I'd say, don't worry about it. But there's country risk, right? Now, the nice thing about teaching corporate finance is there's always a real world example of something happening. You say, look, I don't have to talk about country, just look at what's happening. If you'd invested in Russia pre-2022, you're feeling country risk right now, right? It's got nothing to do with exchange rate risk at this point. It's political risk, economic risk, that the economics of your project from this day on could be damaged. So you see where this will lead us, right? That 6.61% is the cost of cap for a typical Disney theme park in 2013. But that typical theme park in 2013 was in a developed market. I need to charge an extra risk premium because this theme park is in Brazil. And guess what? We've already done the groundwork for doing that. If you think about what we're I'm sorry, same page. What we're looking at here is we're looking at how to bring in country risk. And this is why we spent so much time talking about country risk premiums and bringing in country risk premiums. So here's what I'm going to do. The risk-free rate is still 2.75% because I'm doing everything in US dollars. The beta is still what it is, right? It's a theme park investment. The only number that I should be changing is my equity risk premium. I was using a 5.5% premium for mature markets. But because Brazil was riskier, if you remember, I estimate an additional risk premium of 3%. All I'm going to do then is recalculate my cost of equity with a higher risk premium. And my cost of equity is now going to reflect the country risk. In other words, if you're a multinational, God help you if you keep using the same cost of capital around the world. Even if you're doing everything in US dollars, because if you're investing in Nigeria, or Russia or Brazil, there should be an additional risk premium. So what this effectively does, it pushes up my cost of equity. And with that higher cost of equity, my cost of capital, instead of being 6.61%, becomes 8.46%. So all I'm doing is taking that 6.61% calculation, replacing the equity risk premium with the equity risk premium for Brazil. Now, do you see, if I asked you what would the dollar cost of capital be if the next Disney theme park were in, I don't know, Peru? You just replace the equity risk premium for Brazil with the equity risk premium for Peru. It's a very simple calculation, but it does require bringing in this mindset of wherever I am in the world, I've got to bring in the country risk into my discount rate. So that took a little tangent. But if you adjust for country risk, then the cost of capital for this theme park becomes 8.5%. What did the accounting return for this project look like? 4.18%, right? it looks like the project is earning a return well below the cost of capital. Remember, you're the decision maker. I come to you with this number. If you just take those numbers as your ending point, what are you going to do on this project? You're going to reject it, right? The return you're making on the project is much lower than the hurdle rate or what you need to make on this project. So I'm going to play a little bit of devil's advocate. When you say reject, I'm going to say, before you make the decision, I have a couple of things I want to add. First, how many years of earnings did I project out to get my return on capital? 10. Why did I stop at 10? Because that's what most people do, right? That's the real honest answer. Half of all project analyses in the US have 10-year time horizons. You know what I think the biggest reason is? Before you had shrink to fit with Excel, 10 years was what you could feel comfortably going landscape on Excel on one page. You think, what's the big deal? How infuriating it is when one column keeps popping up over and over again. There's really no good reason for 10. The response I usually get is, but you got to pick a number. You got to be consistent. But is it really fair to use the same 10 years for every project? In fact, with this particular project, the theme park, I can argue that you're being incredibly unfair by killing this project off after 10 years. Because we know what happens to theme parks, at least the ones that Disney builds, as they age in terms of earnings and cash flows. You know that Disneyland, when it was opened in 1958, lost money for Disney for the first 6 years. Then it started making money. Now it's a money machine. Disney World, the same thing. When Euro Disney opened in the 1990s, there are all these stories in the Wall Street Journal about how terrible this was because Disney was losing money. Because infrastructure investments, the first 10 years are when you're building up. I'm killing this project off at its prime. There's a logical fix for that, right? Don't stop after 10. The only promise, it's tedious doing 25, 30, 50 years. And in accounting, you have no choice. You have to go the tedious route. When we do cash flows, I'm going to give you a sloppy way of bringing in what happens after year 10. And then I'm going to defend what we do. But what we're trying to do is essentially say, look, you can't stop a project after 10 years, especially a long-term project, and make your final judgment. So for the moment, at least, any questions on the accounting return approach? I looked at an accounting measure of invested capital, an accounting measure of return, and based on the accounting returns, at least over a 10-year horizon, this project doesn't look good. I'm going to stay on that accounting return measure because over the last 20 or 30 years, especially, in consulting firms and banks, there's this homage that's paid to return on invested capital. It's become this metric that people use over and over without really thinking through its weaknesses and its strengths. In fact, what they do is they take an entire company and they compute the return on invested capital for the company. Let me explain what they're trying to do here. Remember the financial balance sheet? I described a company as having existing investments and investments in the future on the asset side and debt and equity in the other. What you're trying to measure with the return on capital in a company is how good are a company's existing investments? It's kind of a fundamental question you want to ask about any company, right? Because before you become ambitious about the future, you want to ask, are they taking good projects right now? Is a typical McDonald's restaurant earning a 35% return or a 6% return? So return on invested capital is an attempt to measure the quality of existing investments. And here's what we do, and it's flawed, but you can, at least I want you to see the logic. I take the total after-tax operating income for the entire company because that's a portfolio that's coming from the portfolio of all of their existing projects. And I divide by the total invested capital of the entire company. How do I get invested capital? I do it the same way I did for an individual project. Take book values. But because I don't want to add up the book values of individual projects, it's too messy. I take the total book value of debt and the total book value of equity. I add them up and then I subtract out cash. Why do I subtract out cash? Because that cash is not invested in projects per se. It's generating a fair rate of return invested in T-bills or commercial paper. Book value of equity plus book value of debt minus cash is called invested capital. In the case of Disney, that invested capital was $54.9 billion. You divide the after-tax operating income by the book value of capital, you come up with a return on capital of 12.61%. With all the caveats about this being an accounting number and based on 1 year's earnings, if I believe that number, here's what I can do. I can take the 12.61% and say that's what Disney is making on its existing projects. If you remember, the cost of cap for the entire company across the business was 7.81%. I can compare the 12.61 to the 7.81%. And that difference is a measure of excess return, what you're earning over and above your cost of capital. And at least based on the numbers I have for Disney, it looks like they're earning 4.8% more than their cost of capital. I want you to try to do this for your company. And if you find that your company earns more than its cost of capital, and many of you will, or at least some of you will, I want you to ask a follow-up question. Why? See, what do you mean why? Remember Econ 101? If you lived in a perfectly competitive product market, what kind of return should companies make relative to their cost of capital? Perfect competition. The excess return should be zero, but the return on capital should be equal to the cost of capital. So when you earn more than the cost of capital, what are you implicitly telling me about this company? First, you're telling me it's not a perfectly competitive marketplace, and you're also telling me this company has some kind of competitive advantage, right? Some kind of barrier to entry that prevents other companies. In the case of Disney, the answer is pretty simple. What's that competitive advantage? It's Mickey and all the characters that have essentially built up this company. Some of the most iconic brand names in entertainment. Yeah.
I know this would be sloppy, but shouldn't we adjust the capital side of the equation, like to reflect intangible?
We'll talk about that because this is, no, you're right. We're trusting accountants to measure book value capital. We're trusting accountants to measure earnings. And to be quite honest, that's a scary place to be, right? Because accountants don't always measure things consistently. So I'll talk about the corrections you might need to make. But the starting point is you take after-tax operating income divided by, and 90% of people, when they use return on capital, this is all they do is they pull the numbers right out of the financials. I did this for all 5 of my companies. For Vale, the return on capital is 10.4%, more than the cost of capital. What's the competitive advantage there? You already own the low-cost mines in iron ore. That's going to give you a competitive advantage. In the case of Baidu, return on capital of 30%. And here the point that was made about do you want to trust accountants comes in. Because what's Baidu's biggest capital expenditure? We talked about this. It's R&D. And what do accountants do with R&D? They don't treat it as CapEx. So you could actually argue that when you compute the return on equity or return on invested capital for a technology firm or a pharmaceutical firm, you're going to overstate the return. Do you see why? Because your biggest assets are not being capitalized. So if you have a technology firm, don't be surprised to get 70, 80, 500% returns because your biggest assets are not even on the books. For Tata Motors, return on capital is 21%. And almost all of it came from one piece of Tata Motors. Guess which piece it was? It was a Jaguar Land Rover piece. Tata Motors India is pretty much a cost of capital business. And finally, for Bookscape, using that total beta approach to getting cost of capital, their return on capital is slightly lower than the cost of capital. And most private business owners, if you are being honest, you have to say, look, you're probably going to earn less than what you could make if you took the capital you have invested in this business and just put in a mutual fund. But hopefully you're getting some emotional dividends from running your business. And if you don't, just stop. If this is a pain in the neck and you don't want to get up at 6 o'clock in the morning and work 18 hours every day, making 1% less than what you could have made putting your money in a mutual fund is not a great place to be. So the return on capital versus cost of capital becomes that spread that you look at. Now, the point that was raised about, hey, do you want to trust accountants? I don't. So I have an entire paper on the adjustments I make to accounting return on capital to make it more trustworthy, even though not completely trustworthy. Like what? First, I start with the earnings numbers. There are things that accountants do to earnings that are a little troubling. For instance, the fact that they expense R&D. Until 2019, they were treating leases as operating expenses. The first thing I'm going to do is I'm going to try to clean up the earnings for things I think should not be accounted for the way they are. But it's the invested capital that I have to do the real cleaning up. If I had my druthers, I would capitalize R&D. I would capitalize customer acquisition costs. I would capitalize, some of brand name advertising, because to me it's capital expense, which is going to increase my invested capital and at the same time affect my operating income. I'm going to capitalize leases. I was doing that before 2019. Now, of course, accountants are doing it for you, but I'm not quite done. One of the things that can really throw off your return on capital is something companies do for the most sensible of reasons, which is if you take a project and it turns out to be a terrible project, and everybody comes to the conclusion that it's a terrible project, what are you allowed to do as a company? You can write it off, right? You're saying, what's the big deal? That's a sensible thing to do. And in the year that it happened, so this year, for instance, any company with significant Russian operations is going to take a write-off. Some of them are never planning to go back in, right? BP pulling out of the joint venture, that's going to be a multi-billion-dollar write-off. You're saying, what's the big deal? Let's say it's 3 years from now. I'm computing the return on invested capital at BP. What do? I take the book value of equity, the book value of debt, and subtract out cash. What I'm failing to factor in, the book value of equity was reduced by $18 billion in 2021 or 2022. So essentially, when I use that adjusted book value, I can come to this very misleading conclusion that this company is taking great projects. There's a way to fix it, but it's painful. You know what I have to do? I have to go back and reverse every accounting write-off over time to see what the invested capital would have been over time. Just computing return on capital. I'm sorry, do you have a question, or is that your mic just on? Okay. Just computing return on capital can be a tricky process. So when consultants and bankers just throw around ROIC, they were actually made an acronym. Many of them, I don't think even remember what the expansion is, just ROIC. Stop them and say, can you go through this calculation? Because we want to make sure we're talking about a number that we can trust. So at the start of every year, as you know, on my website, I download the data on every publicly traded company in the world. Sounds like a lot of work, but I use S&P Capital IQ. It takes me all of 30 minutes to do. And then I clean up for the accountants. I capitalize leases, I capitalize R&D, and I compute the return on capital for every company. Still an imperfect number, but less imperfect than when I started. I also compute the cost of capital for every company using the approach that we talked about, estimating beta risk. And I do everything in dollar terms so I can make them comparable in a sense across the world. And I'm going to show you a graph that to me is the most depressing and the most eye-opening graph that I do every year. Here's what I do in this graph. I compare the return on capital. There are 46,000 publicly traded companies in my sample. I compare the return on capital for each company to the cost of capital. It's a very simple comparison. So if your cost of capital is 7%, your return on capital is 11%. And I then draw a histogram of what the world looks like. Take a look at that histogram. Okay? If you look across the world, about 57% of companies earn a return on capital less than the cost of capital. 43% of companies earn a return on capital that's greater than the cost of capital. Already with just a comparison, 57% of global companies don't earn their cost of capital. It's worse in some parts of the world than others. It's worse in some sectors than others. In fact, I use this comparison to come up with a list of my 10 worst businesses in the world to be in. You want to guess some of the businesses that make that list? The airlines obviously has been making the list since 1977. Why? Because they haven't figured out how to deal with deregulation still. Any other guesses?
Retail.
Brick and mortar retail in the US especially, not so much globally yet, but brick and mortar retail in the US. Because remember, if you use Amazon as part of retail, it looks pretty good. Automobiles outside of Tesla. Tesla doesn't make a return on capital that exceeds the cost of capital, but at least there's hope, right? Once we grow, we'll make the return on capital. Telecom. used to be a good business 15 years ago has become a bad business. Why? Because technology. Telecom used to be a good business because what was the competitive advantage if you're a cable company? You put the cable in and then you're a monopoly, right? Today you put the cable in, you might hope to have a competitive advantage 3, 4, 5 years, but then people deliver your TV through satellites and deliver through fiber optics. So next thing you know, your competitive advantages are disappearing. What I'm trying to say is what you get as an excess return is a number. What I want you to do is take that number and tell me a story. Your project is not about grinding out numbers. You know what? I actually have a pre-made Excel spreadsheet where you put in the inputs. It'll do the entire number crunching for your project. That's the trivial part. It's taking those numbers and telling a story about the company. That story could have a happy ending or a terrible, so it could be a horror story, but essentially that's what you're getting when you look at the success return. Any question on accounting returns? So take your company, compute the return on capital. You don't have to, if you want to capitalize R&D, I give you a way of doing it, but if you just want to compute a conventional return on capital, just stop for that for this, at least for corporate finance. In valuation, I'll push you to kind of try to convert those capital, the operating expenses into capital expenses. So compute the return on capital compared to your cost of capital. And that's why I was pushing you to try to get your cost of capital nailed down, because the return on capital actually takes 5 minutes to do. So you got a cost of capital, at least you can make that first level comparison about the qualities of the projects that your company is taking. And cut your company some slack if it's a young company. If you're Peloton, even if you think the company is going to come back, its return on capital today, it's not going to exceed its cost of capital. Young companies early in the life. So sometimes you might see a company with the return on capital is less than the cost of capital. You would say that's okay. It's a young infrastructure company. It's a young young growth company. So sometimes just the fact that you get a negative excess return doesn't mean it's a bad company. But sometimes you're going to take a look at the negative excess returns for United Airlines saying, what's the end game here? I don't see a light at the end of the tunnel that's going to make these numbers turn positive. And that's going to color how you approach the rest of this process. You know what I mean by the rest of the process? You got to tell me whether the company should be returning more cash or less cash. And if you think there's no light at the end of the tunnel and this company is earning less than the cost of capital, the logical next step, right? Don't take any more projects, don't expand, liquidate yourself over time and become a smaller company. So that's the earnings part. But as I said, accounting returns fail the good return measure test on all 3 levels. So let's go through and try to fix each one at a time. First, let's go from earnings to cash flows. To get from earnings to cash flows, and we do this in valuation of corporate finance, is actually a very straightforward 3-step process that people overcomplicate all the time. Here are the 3 steps. You start with the income, whatever measure of income you have. You add back depreciation and amortization. You know the road answer for why we do that, right? It's not a cash expense. It's an accounting expense. So we add that back. I'm going to come back and take a closer look at that because the adding back seems to be you're neutralizing the effect. We'll see that even though you add it back, depreciation amortization leaves an imprint on your cash flows through the taxes. Then I'm going to subtract out capital expenditures. Why? Because even though the accountant tells me not to worry about it, if I have to spend $10 billion, that's cash leaving the company. So I'm going to subtract out capital expenditures. And then I'm going to subtract out working capital changes. Why? Because I want to make my accrual earnings into cash earnings. So it's a change in working capital that affects my cash flows, not the total working capital. So let's take each of those and kind of isolate the effect. So in this case, if you look at adding back depreciation, subtract out CapEx, subtract change in working capital, these numbers look very, very different from my accounting and earnings numbers, but they reflect a much more honest perspective. Because even though the accountant says nothing is happening in year 0 and year 1, that's when I'm spending billions of dollars building the theme park. So you're seeing negative cash flows up front. And if you look at break-even points purely in terms of cash flows, it happens in year 4 and then it builds up over time. So let's take each of these adjustments and talk about what they do and why we do them. First, if you look at depreciation and amortization, you subtract it out to get to operating income, and then you add it back, right? So if you focus on those two line items, your reaction is, doesn't matter. Let's take it out of the process. That's what drives investment bankers often to use EBITDA and forget about the DA. But there's a reason why you don't want to forget about the DA. Is when I subtract our depreciation to get to taxable income, it saves me taxes. So if you wanted to isolate the tax effect of depreciation, see the depreciation numbers I had in the same pocket. I multiply by the tax rate. That is how much money I'm saving because I'm depreciating this asset. I'm using that marginal tax rate of 36.1%. So here's my first proposition. The tax benefits to depreciation will be far greater if you have a 50% tax rate than if you have a 20% tax rate. And they will be non-existent if you have a zero tax rate. A lot of hospitals are nonprofits. And many hospitals have huge capital expenditure, right? The big X-ray machine, So if they buy the machine on their own and they depreciate it, it gives them no benefits because they have no taxes. But let's say you are a wealthy investor. You don't need an X-ray, 50 X-ray machines in your home, but you buy these X-ray machines, you get a much larger depreciation, right? Because of your tax rate. You're saying, what am I going to do with 50 X-ray machines? You lease them to the basis for leasing as a business comes from the fact that different people have different tax rates. If you have different tax rates, the person with the highest tax rate will get the biggest tax benefit. Second, non-cash charges that are non-tax deductible. And there are some, like some amortization is not, you might as well ignore. Because then what's the point of subtracting it out if it's not going? So if you're not taxed as an entity, you can ignore depreciation. But if you're taxed as an entity and there are amortization expenses that are not tax deductible, you can just ignore them entirely in your analysis because you're going to subtract it out. It's not going to affect your tax, and then you're going to add it back again. So the effective depreciation shows up in the tax benefits. So I want to isolate that tax benefit effect and ask you a question. In the old days, as I said, companies used to have a choice of what depreciation method they could use to depreciate big capital expenditures. So I want you to think like the CFO of a company. You made a big capital expenditure, and I give you two choices. And there are hundreds of potential depreciation methods, but I'm going to classify them into two groups. One is straight line depreciation. What is straight line depreciation? You depreciate an equal amount each year. What does it have going for it? It's really simple to do. The second is accelerated depreciation, where you take more depreciation up front and less later. You get the same total depreciation, but the pattern of the depreciation is different. So I'm going to separate the effects into two questions. So you've taken this huge investment. You're trying to decide, should I depreciate it straight line or should I depreciate it using an accelerated depreciation method? Some of the years. Which one will give you higher earnings in year one? Let's keep focus on the early years. Which approach is going to give you higher earnings early on? Straight line or accelerated? Straight line, because you're going to get. Which one's going to give you higher cash flows? Accelerate. It'd be nice if you could have your cake and eat it too, right? You know, US companies are actually allowed to use different depreciation methods for the reporting books and for the tax books. If you're allowed to use different depreciation methods for your reporting and your tax books, in your reporting books, guess what you're going to use? Straight line depreciation, because it increases the earnings. You want to report higher earnings. In your tax books, you're going to report accelerated depreciation. We never get to see the tax books for companies. We see the taxes, accrual taxes and cash taxes. And sometimes you wonder, why are those numbers so different? Here's one. So depreciation is one of those items where you want to get the most depreciation you can have up front if you're running the company for its cash flows. But you want to get straight line depreciation if you want to report the highest earnings you can. Yeah. It's a good question. I think that in some countries it's not. But actually the defense they offer is it's allowed, but you can see in the accounting statements the effect, the deferred. So if you took into account the depreciation, the deferred taxes, you can back into what's happening. But you're right. I mean, why even let companies continue to do this? In fact, it gets worse in a minute. Let's look at capital expenditures. Remember, I said there are two, when people think of capital expenditure, they think about the upfront investment you got to make. And that's a good thing to think about. In this case, $4.5 to $5 billion, but they stop there. But as I said, if you want to keep this project going, and that's a decision you make, you might decide to run the project into the ground. But if you want to keep this project going, you've got to also invest in capital maintenance. Capital maintenance is not just maintenance. It's actually buying new physical equipment to replace old ones or changing the way you look at this. So capital expenditures reflect what you got to get the project going. Capital maintenance is what you do to keep the project having a longer life. Here again, I want to focus on the earnings and the cash flow effects. On most items, you don't have a choice. It's either a capital expense. The tax law says you can't, you have to make a choice, and it's based on what you invest in. But let's say you have an expenditure that could be treated as a CapEx or could be treated as an operating expense. Let's say there's a point where we get to R&D and I say, you know what, you can treat R&D as an operating expense or I can treat it as a capital expense. Let's first start again by looking at the effect of that choice on earnings. Which one is going to result in higher earnings? Capitalizing or expensing? Capitalizing, because you're spreading the expense over time, right? If I expense it, it's going to mean lower earnings. So when you look at the effects of expensing or capitalizing, you can see that the earnings effect is going to be much greater if you expense it. So when you expense R&D, it looks like you're making less money. But from a tax perspective, you know what's going to give you the bigger tax benefit? You have a choice. Should you expense things or capitalize them? Always expense them from a cash flow perspective. Unless you're a money-losing company. Do you see why that matters? If you're a money-losing company, why expense it? In fact, you want to spread it out over time so that you don't end up losing the deduction. For a money-making company, right? This plays out now with technology companies, with customer acquisition costs, because they want to have their cake and eat it too. So the Groupons of the world, when they went public, said, you know what, guys, 50% of our expenses are to acquire new customers. They're like capital expenses. So they said our earnings would be much higher if we didn't have those expenses, add them back. Nice. But then if you think about the cash flow effects, if you were actually doing this on a cash flow basis and you were actually paying taxes, you could very quickly see the impact on your taxes. So this is something I'd keep my eye on because accountants are increasingly giving companies more discretion on what to capitalize and what to expense. But like depreciation, the choice can have implications. Finally, let's talk about working capital. We do this as a line item. We don't even think about it. But no, I've been teaching here for 36 years. I walked up and down Bleecker over that period. You know how much turnover there is on that damn street? Nothing stays there for more than a year. It's like, and especially if you open a new retail store, it doesn't last at all. And one reason I think is people underestimate the way down on cash flows from having inventory and having receivables. In fact, I think people consistently underestimate what effect it has on cash flows from having all those items. Imagine running a retail store, right? You want to have inventory. Why? Because when customers come in and ask for a product, if it's not on the shelf, they're going to go somewhere else. But when you have inventory and it sits on the shelf, it ties up cash. And in fact, the faster you're growing, the more inventory you got to keep. This is one of the great ironies in businesses like this, is you can go bankrupt because you're growing too fast. You're actually doing really well in terms of revenues, but you're selling a lot of stuff on credit. You have a huge amount of inventory. Your cash runs out. But there's a fix for that, right? When you decide whether to open the store, you need to bring into your cash flows the drain you're going to have, because it's not something that happens unexpectedly. It's completely expected if you build it in. That's what we're trying to do with working capital. So when you fail to consider working capital, you're going to overstate the value of a project. You're going to open stores you shouldn't be opening. And then you're going to run out of cash and say, what the heck happened? But if you run a store and there's working capital requirement, it'll lower your cash flows, and managing working capital better will actually be a way in which you can increase the value of your project. I remember when Walmart first came into the business, the rule with retailing used to be that your current ratio had to be 2. You know what that means? I mean, I was taught this in my accounting class 40 years ago. Your current assets should be twice. Who makes up these rules? And that's exactly what Walmart does. Because that rule was costing them billions of dollars. Because if you want to keep your current assets twice your current liabilities in your retail firm, that means you're going to drain your cash flows. You could be growing, but you can. So they said, look, we're not going to keep it at 2-to-1. That's some accounting rule. We're going to try to make working capital a neutral effect. We're not going to try to generate cash flows from it, but basically we're going to try to keep current assets close to current liabilities. And how does Walmart pull this off? I mean, they pioneered the just-in-time inventory where people would go around shelves and check to see what you did so that you didn't have inventory building up. They squeeze suppliers by saying, look, if you sell to us, we won't pay you for 2 months. Our customers might pay us right away. Essentially, I'm not saying this is the right thing to do from a supplier perspective. It clearly hurts them. But their objective was to bring working capital down, because if you can manage working capital better, it's higher cash flows. So earnings to cash flows, depreciation and amortization, the tax effect is CapEx, which obviously affects your cash flows and also your taxes and working capital. Any questions on those 3 line items? Let's talk about incremental cash flows. So we fixed one of the 3 problems, right? We've gone from earnings to cash flows. Let's go from cash flows to incremental cash flows. There are 2 items I want to fix. The first is, and this was a point made earlier, right now, when I'm looking at my investment, I'm including the $500 million that I've already spent. And I'm not going to get it back. I mean, in finance, we call it a sunk cost. We tell people exactly what to do, and 90% of the time, they completely ignore us. I'm going to see why. But that $500 million has already been spent. I'm not going to get it back. To reject this project with that $500 million built in is kind of not going to make that money back. The second item that I want to focus on is that allocated G&A, where I told you up front that 2/3 of this G&A have nothing to do with the project. The accountant allocated anyway, but I'm going to go back and fix that because that 2/3 has nothing to do with the project. So let's start with this. So basically what I've done here is added back the $500 million to my initial investment. Take it. So basically my initial investment becomes $2 billion instead of $2.5 billion. Okay. I've also added back the portion of the allocated G&A that was non-incremental, saying I should never have subtracted that. Now, this is a little tedious. It's easy to get mixed up on what you add back and what you subtract out. So I'm going to give you a much cleaner way of computing direct cash flows or incremental cash flows. Just focus on the incremental items. What does that mean? When you do your expense, instead of subtracting out the entire allocated G&A, subtract out only the incremental G&A. When you do your investment, rather than focus on what the accountant tells you the investment is, focus on the incremental investment. You get exactly the same answer as doing the adjustment that I just did, but it's a much cleaner way of doing it. In fact, get used to doing both, because then you can check your answers to make sure that they're right. So this is an incremental cash flow. It reflects what this project can do. So let's talk a little bit about sunk costs. Now, every finance book you open up and define sunk costs. Sunk costs is something you've already spent. You're not going to get it back. There's no point shedding tears about it now. Make your decisions based on what you expect to happen in the future. You know how difficult it is to ignore sunk costs? As a person. I do this with the valuation class. Usually, most of them are second-year MBAs, where I ask them to evaluate the net present value of getting an MBA. It's a little late to be doing that, right? You're already in the second year of an MBA program. Stern is going to suck up the tuition for all 4 semesters. It's too late to get it back. So it's a sunk cost, right? But at least you can say, look, I have 1 semester left. I might as well save that last semester and walk away. But it's very difficult as human beings to ignore what's already happened. One of the most famous experiments run on this was an experiment called the Concorde experiment. It was basically said in a hypothetical aircraft company. And this was actually run as a physical experiment, two groups of people. And this company had come up with this new aircraft that they'd spent billions of dollars already developing. And they'd reached the stage of the decision process. They divide them into two rooms. The first room, the person describes the aircraft and then says, look, this is what we've already spent. But by the way, one of our competitors come up with a much better aircraft. But we've already spent 7 years and $15 billion building the aircraft. And then he asked the 50 people in the room, should we keep going? And then he goes to the second room and does the same thing, but doesn't mention the fact that they've spent 7 years and 50. In other words, it's the exact same facts. The only difference, in one room, they were told how much money had already been spent and how much time. And you know, the difference was, right? The room where people were told what had already happened were much more likely to stay with the project because they felt that because you'd spent the money and the time, they didn't want to walk away right now. Life is full of choices we make like that. How many people are stuck doing things that they should be walking away from because they've already spent 11 years doing it? No, I think that's more the rule than the exception. So in business, people constantly make decisions based on things that they shouldn't be. So one of my pieces of advice is, if you're doing a project analysis, don't spend too much time describing what you've already spent in the past or how much time you spent on it if you want good decisions to come out of that room, because that's going to skew the decision making. But it does raise an interesting question about sunk costs, because even if you take finance's advice at face value and say, look, I'm going to ignore sunk costs, they present you with a question, and you can see why this is going to potentially become an issue. Let's assume you're a consumer product company. You spend $100 million in test marketing a product. And after you've test marketed the product, so you've spent the 100 million, you collect information about the project, then you do the cash flows based on the future, and you come up with a net present value of 25 million based on all future cash flows. What does traditional finance say? If the net present value is positive, take the project, even though you've spent $100 million. The fact that it's the 100 million is been already spent means it's a sunk cost. So that's perfectly rational, right? You've reached, you've spent the 100 million already. Right now, you look back and say, I wish I hadn't done that. But that's not going to bring the 100 million back. But let's assume that in every project you look at as a consumer product company, this is what happens. You spend the 100 million. Then after you spend the 100 million, look at the project makes 25 million, and you take the project. You know how long you can last in business? Not that long. You see the point I'm making? A lot of companies spend money on R&D, and after they spend money on R&D, they say, should we do this, continue with this drug or continue with this project? And by the time you get to that point, the money has already been spent. Pharmaceutical companies learned this the hard way in the last 20 years, because in the first, in the 1980s and 90s, what pharmaceutical companies did was cost plus, which is if you spend money on R&D, because of the pricing power, they could just pass it through and get the money back. That business has become, the pricing power for pharmaceutical companies is still there, but not as significant as it was 20 or 30 years ago. So if you give R&D a blank check and they spend $8 billion on a drug which creates $1 billion in value, you're going to very quickly start to run out of value. So the point I'm making is, if you want to make these decisions rational, you need some decision happening before you decide where to spend money on R&D. I know right then you're going to say there's a lot of uncertainty. Doesn't matter. You still have to make a judgment of where should we be investing our R&D, and is there a potential payoff that will justify that investment? It'll piss the R&D people off because they feel that they have the right to spend money on R&D because it's good research. But if you're a commercial enterprise, you got to make sure that that R&D money is judged before it actually gets spent. And finally, on allocated costs, right? I know accountants like to allocate costs, but many of those allocations have nothing to do with your project. So you're rejecting a project based on an allocated expense that shouldn't even be a factor in the decision. So we know what to do, add back the incremental. But you're saying, how will I know how much of that? So when I told you there was $1.5 billion allocated to the project, saying, how in the real world would I know how much is direct and how much is incremental. I'll leave you with an example and I'd like you to think about these numbers and tell me at the start of the next class whether you can use these historical numbers. So this is a company, I've given you the last 3 years of G&A costs, or 3 years of G&A costs, $1 billion in revenues, 250 million. So I've given you the revenues and G&A costs. Can you use that information to extract at least a measure of how much of the G&A cost of 300 million in year 3 is fixed and how much is variable? It's just basic statistics and common sense. Take a look at those numbers. We'll start with that question because we want to be focused on the incremental expense, not the total expense when we look at rejecting or accepting a project. So I'll close there and I will see you on Wednesdays. If you get a chance, please do read the case because as I said, much of what we talked about today, as you read the case, is going to kind of register and you can start building up the project analysis.
Yes.
Question.
Yeah.
About the treatment of depreciation accelerated versus straight line. So, and I guess it was about the choice of